But it really is about balance and making sure that you're saving the appropriate amount. I mean, general rule of thumb around 20% is great if you have the capability to do that, but we want you to enjoy life now as well.
I am really excited to be talking with Laura Christofferson today. She is the co-owner of Alden Capital Management LLC in Bellevue, and she's a second-generation certified financial planner with incredible knowledge and experience. She's also a certified Divorce Financial Analyst, which is a very rare designation. She was also just named 2024 Best In-State Women Wealth Advisors. So I'm excited to get into it. Welcome.
Thank you. Thank you so much for having me. I'm excited for our conversation.
Yes. Oh my gosh. Well, thanks for joining us. I'd love to have you kind of share with me a little bit about your background and, how you got into the business, why you love being a financial planner, and just kind of how you got into it.
Sure. So I have been in the industry now for 13 years, and I joined our family firm back in 2011. And this is a family firm. So my dad, even though I've only been in the industry for 13 years, I actually grew up in the industry.
Yep.
And so I joined the industry in 2011, and my brother was already there. And then him and I actually purchased the practice in 2017, and we are co-owners together. So I was very fortunate to grow up in a household where we talked about finance and economics and money. And the best part of my job is really being able to share all of that knowledge with my clients and to be able to give back in that way and help them to achieve their financial goals and really enjoy their retirement.
Yeah, I can only imagine there's got to be a big advantage growing up in a household where you're talking about, money all the time. It's just it's in your mind. Yep. Tell me about when you were a kid, some of the things that, you would talk with your dad and mom about, and, kind of some of the things your dad would do with you and your brother early. I think it's super cool. You run your firm with your brother too.
Yeah. I mean, I think in some families, unfortunately, it is taboo to talk about money, and that just wasn't the case in our household. One of the coolest experiences I ever had was I actually got to go and be on the floor of the stock exchange when I was 16 years old. And it is exactly like the movies, or it was back in the day, and just complete chaos, but a lot of fun. But no, it's just being a family firm. It is so important that we just, reach out to the next generation and teach them all these skills. And, there's a lot, I think it's great with social media and the internet and what's available today that wasn't back when we were growing up, but there's also a lot of misinformation out there as well. So, as an advisor and a professional, I think it's important to be able to relay the actual facts to our clients and to everyone.
Yeah.
So, yeah.
It's like a lot of things. There's a good amount of information out in the internet, but there's a lot of misinformation, and people need, and everybody's situation's different. No two people are the same. Yeah. No two financial situations are the same. And it comes down to really being able to advise, I would imagine, and just being able to look specifically into them and what their goals are. But that's really neat. I agree with you. It's having grown up second generation. My dad was in mortgage for 40 years. I feel like I learned it as my second language growing up, and it kind of just gives you a leg up, and having those understandings of just how the markets work, how money works, how to start, where to start, how to start with savings and so forth, and grow into investing, and kind of how to determine what's appropriate. So yeah, very cool. Well, when I work with clients, I tell them, especially when they come up, when they're getting ready to buy their first home, that they have entered a realm where it's really pertinent that they've got a long-term financial plan, and they really need to talk with a financial planner and who's going to be able to go through and look at the overall picture, how that mortgage, how that house fits in to their overall plans for their life, for retirement. So I'd love to hear from you kind of when you talk with clients, at what point and what would you say the big advantages are for a client to hire a financial planner? And also, there's different designations. I know there's financial advisor, there's certified financial planner, which is what you are. And I'd love to have you kind of talk about what those differences are.
Yeah. Well, so first, I think the biggest reason to hire a professional is to take the emotion out of investing in finance. It can be extremely emotional. And if you're working with a professional, they can help you to go through the ups and downs of a market. We know intuitively that markets go up and down, but if you work with a professional, they can help you to put a good plan in place to be able to go through all of that volatility. And I think this past month was the perfect example of that. The beginning of 2024 was very low volatility. And even 2023 was obviously a great year for the markets. So over this past month, we saw the markets pull back. And I think people had become a bit complacent and forgot. But if you're working with a professional, you hopefully have a plan in place. And, you can go through and say, okay, did this pull back? Did this have a big impact on my personal situation? And I think also a professional can help to point out any blind spots that you might have associated with your particular situation. So I think those are really the big things that a professional can help you with. Obviously, they have all the knowledge, but, and then, a certified financial planner professional, only 1 in 10 advisors has the CFP designation.
Interesting. I didn't realize that.
So
that's good to know.
They're going to really focus not just on selling you a particular product, but really looking at your holistic, plan, your goals, and finding that appropriate risk tolerance for you. We use both quantitative and qualitative tools to determine a client's actual risk tolerance, not just what they come in and sit down and tell you in the meeting. So I think that that's extremely important to understand their true risk tolerance that's going to help them to meet their goals.
Yeah. And risk tolerance in that, like, when you're going along and all of a sudden you get a, blip in the market or a dip in the market, which is normal. It totally happens. It doesn't always go up. Like I tell people with rates, doesn't always go up, doesn't always go down. It fluctuates. So markets are the same way. But that risk tolerance, I would imagine, probably helps you determine, okay, what can their stomach handle when we hit those points?
Yeah, because staying invested is so key. And not attempting to time the market. And again, this past month, perfect example of that. If you would have panicked during that, it was only an 8.5% pullback, but if you would have panicked, you would have missed the past few weeks, which we had 8 straight days, consecutive days of up markets. And I believe it's JP Morgan has some really great charts on this that show you what happens to your portfolio when you miss some of the bigger days in the market. And it's pretty incredible what it does to your overall returns. So I think it's really important to understand what a client can handle in terms of volatility and to help them stay invested in the market.
It's one of the things I always say to clients is like, it's time in the market, not timing the market. But I'd love to hear from you as an actual professional that does this for a living, like, how you kind of explain that. Like, what's your definition and how you explain that to clients?
That was perfect.
Okay.
That was incredible. It's exactly right. It is amazing compound interest over time and not attempting to, you do not have to perfectly time the market. That is one of the things, and no one is going to. Right?
No.
So I think that that's a great way to say it.
I've always heard that it's like there's every year they publish a list and it's maybe 20 professionals that can ever outpace the S&P. Is that
the actual
correct?
Market, correct, yeah.
Okay, it's pretty hard.
It's very hard. And it's hard to repeat that consistently. Yeah, absolutely.
For sure. I would imagine. What kind of, what overall services do you provide, like as a certified financial planner to your clients?
Yeah, so both Matt and I have our CFP designations, and so it really does all start with planning, and we offer a full suite of planning services. But what we focus on are distribution planning during retirement, and also with estates as well. Tax efficiency is really important, and wealth accumulation. That's also super important. You know, we think it's really imperative to work with a team of other professionals as well, such as your CPA, your estate planning attorney, your lender, real estate agent, your insurance individual, whoever that might be. So I'm not a CPA, although I always joke that I'm married to one. And, you know, so we can't provide professional tax advice, but we do try to be as tax efficient as possible. And there are a lot of strategies out there that can help to offset and create tax losses even during up markets. So I think that's really important, particularly for people that are in real estate or interested in real estate, having those types of options available.
Oh, for sure, because it's about overall. And you know, I always say when I'm working with clients, I love it when they have a great financial advisor that they're working with, because we can make sure that whatever we're doing in their mortgage situation fits into their long-term plan, because I don't know what that long-term plan is a lot of times when they come to me, and I ask them about that, and you know, we get into a great conversation, but it's always more helpful, especially if it's complex, if we've got their financial advisor, their CPA involved in many cases, to really ensure that we're giving that support and making sure that, you know, whatever type of a product we would put them in on their mortgage fits into where that long-term plan is going. At what point do you think what stage in a person's financial journey do you think is kind of optimal for them to hire a financial planner?
Ideally, as soon as possible, as early as possible. It's amazing how having a good plan in place will allow you to reach your goals so much earlier, or undo a bad plan also that's been set in place. So as early as possible, you know, we talked about we're, you know, a family team. And so we have multiple generations. You know, we work with the grandparents, the parents, the children. And one of the things we do for our clients is that we will offer a free 1-hour consultation with the children or grandchildren that are not necessarily clients, and just sit down with them and go over some of the basics, you know, personal finance basics, see if there are any red flags there, and just help to put them on a good path, because that, I mean, again, starting early is going to set you up to be able to retire earlier if that's a goal of yours, or just meet any of your financial goals along the way. Yeah.
Oh, absolutely. What would you say? Like, I talk a lot about money mindset. Like, money mindset, I think that's always important for me to understand when I'm talking to clients and talking to them about their mortgage and trying to understand kind of their risk tolerance. And, you know, money mindset, I think, is an important piece. And what would you say, you know, like thinking about your own life, what's your money mindset, and kind of how has that changed over time?
I think it's changed a lot over time, particularly as, you know, I've become a mother. And I think now it's truly about balance. And that's really my money mindset, because, you know, working with clients, I've seen, unfortunately, in some situations where clients, you know, spend their whole life saving, and they're really dedicated to that, which is great. It's wonderful. But then they get to retirement, and they, you know, their whole plan was just to have this incredible retirement, and they get there, and unfortunately a health concern or something pops up, and they don't get to enjoy that retirement. So for me, having a roadmap, having a plan in place is going to allow you to enjoy and have that balance, take those trips that you want to take, buy those, you know, for me, it might be a handbag or whatever it might be that you really enjoy, and not be so concerned, because, you know, we have clients that have, you know, millions of dollars, and they will not spend a penny of it. And so part of my job sometimes is convincing clients, not only can they spend their money, but they should spend their money. You know, we will work with clients if they want to pass on money to the next generation or if they want to do some charitable giving. That's incredible, and we have great strategies for that. But it really is about balance and making sure that you're saving the appropriate amount. I mean, general rule of thumb, around 20% is great if you have the capability to do that. But we want you to enjoy life now as well.
Yeah, and that's interesting. Like, I love to hear you say that because, so much, I feel like, growing up and like our generation, a lot of it is like you're kind of bred to work and save and invest, but yet no one really talks to you about, okay, but like, when do you enjoy the fruits of your labor? And because it's important, we've all seen those clients where, I've had those clients come to me they've got this amazing, beautiful house that they've got a ton of equity in, but they are cash poor and they can barely afford groceries because they live on this fixed income, but they've got like $2 million or $3 million in equity that it's like, you deserve to enjoy this. Like, it's your life. Or like you said, the balance piece of it. Because I think when people are just working and they're just socking it away and they're not really thinking about it, like maybe they're not working with a financial planner like yourself, and they haven't been reminded, okay, think about those trips that you want to do or those bucket list items, because you can kick it down the road for a while, but none of us know. None of us know what our time looks like.
Absolutely.
And it's sad to see people die with these unbelievable fortunes that they never enjoyed.
Yeah.
So, yeah, I love that.
And it's, we joke that financial planning would be a breeze if we knew the date of our passing, which is a bit morbid, but true. And, none of us know. So you do want to be conservative. You want to make sure that you don't outlive your money. But you also want to enjoy it while you're still alive.
Yeah.
So
when you're talking with clients about just kind of what kind of a role does it play just in their overall strategy or like their growth strategy? Maybe you're thinking of, how they're going to grow to get to that retirement level, or, maybe they're thinking they want to get a second home or they want to get into rental properties, or what kind of a role do you feel like, how does real estate fit into that? Kind of how do you think about it, I guess? Do you kind of look at the equity piece of it, or is it more like the real estate's more of like it serves as it's a utility, like they got to live there, and it's not really considered a part of the overall wealth? Yeah. That's kind of where I was going with it. Yeah.
Yeah. No, I think real estate is a really big portion of the overall plan.
Okay.
But it does depend on the client. Some clients don't want to have rental properties or, be involved. They just want their own primary residence. And one thing that has been, especially in the Seattle region, having, a lot of people bought these homes at a relatively low price. Yeah. And now they have accumulated a lot of equity in these homes. And those homes are usually their biggest asset. Not always, but often they're their biggest asset. And those can be utilized as a portion to pay for their care later in life if need be. Long-term, we do insurance planning, we do long-term care planning, but it is extremely expensive and sometimes prohibitively expensive for clients, or they want to self-fund. And that's fine. We go over all the risks and benefits of those. But having that asset that has a lot of equity, has accumulated over this long period of time, typically, that can be utilized to pay for their care later in life if need be. Often they want to pass it on to the next generation or hold on to it for particular reasons, but that is something that we can definitely utilize in the planning portion to help pay for care later in life.
Yeah, I think a lot of people do not realize how much that kind of care costs. Like, it is, until you're in that situation and you're caring for a loved one, like it's astonishing, like what it costs. And if it's, and it makes a big difference, whether it's assisted living, whether you get into medical conditions like memory care. I mean, memory care can be $15,000, $20,000 a month. And if people plan ahead, they can buy tools, and correct me on this if I'm wrong, they can buy tools like a long-term care plan. I don't know how, I would imagine there's probably just everybody's situation's different. So they have to go through a special type of a process to figure out if it's right for them. But yeah, I mean, they can buy some insurance products for that, but depending on how long they live, having that equity probably makes a big difference.
It does. And some people, even if they have the means to purchase a long-term care plan, they may have some sort of health concern that will prohibit them from purchasing that plan. So there are a lot of reasons why people don't get long-term care policies. It's not just the cost. So the equity in their home is an incredible tool to be able to utilize. Yep.
It's interesting because I've always used the adage of like, keep your money moving. It's good to have equity, but don't be equity poor. Like once you've got, so you put, 20% down on a house, that's fantastic. Yep. As it grows, you gain all this equity, but it's also dead equity because the money's not moving anymore. It's not able to actually be doing anything for you. I'd love to hear from you kind of when you look at a client scenario and kind of look at that. If they've got if they're sitting there with a bunch of equity in their house, but yet maybe they are really, they don't have a lot of cash flow. Is that kind of where you start to maybe look at potentially you partner with their mortgage person and
absolutely
look at tools to utilize that and leverage it?
Absolutely. We'll look at, all of the different buckets, what they can tap into. And sometimes, like you said, sometimes people are house poor and that is their main asset. I had a client that lived over in Medina. They bought that property 50 years ago and it was a small home, but just the land alone was worth millions of dollars. But they didn't, they had their Social Security and a small amount of retirement assets, but that was it. But they wanted to stay in that beautiful home and on that land, understandably. So, we worked with their mortgage lender and we were able to, get them income to come in so that they could get care to come into the home and stay in that home. So absolutely, we'll work with other professionals in that particular situation.
Yeah, that's the thing. There's a lot of options for people nowadays that can make sense. There's cash out refis, there's reverse mortgages, I mean, again, everybody's different. So, it's always important to look, but there's always these, some great options that are out there.
Yeah.
But that's one of the things that is really interesting that has gone up a lot in the last, I'd say 20 years. I remember looking at the cost when my grandmother had to go into a memory care facility versus what that cost is now with my own mom, and it's drastically
And we
increased.
have some of the
It's crazy.
highest costs in all of the country.
In Washington State?
Yeah, in Washington State.
Interesting. Yep. Why do you think that is?
We just have a high cost of living here in general.
Yeah.
We do have some of the higher costs. That's really important. And we tend to show people when we're looking at their plan, okay, what would happen if you did have to go into a memory care unit for 3 years? And what's that average cost? And what will that do to your plan? We run a bunch of different what if scenarios to go through that with them.
Yeah. It's interesting. I've had clients ask me, well, if that ever happened, insurance would cover that, right? And I said, nope. Your health insurance does not cover that. So I think there's a big disconnect. A lot of people just do not. They don't understand that you really have to plan for that.
Absolutely. Yeah, there's a big common misconception that Medicare will cover or Medicaid. And you don't want, if you have a loved one, you don't want them to have to go on Medicaid to cover those those expenses.
Yes. Yeah. Those facilities are they're not great.
No.
I have been into a couple. They're not great.
No.
Yeah, they're not. What would you say, there's misconceptions out there on everything, in lending, investing. What would you say some of the biggest misconceptions you get about money, investing, managing money, markets in general even?
Sure. I think the biggest misconception today is that it's easy. We've been in a pretty much 15-year bull market at this point.
Yeah.
And so if you didn't go through the dot-com bubble, you didn't go through the global financial crisis, you've been investing in a time frame that's been great. You know, markets have done extremely well. Yes, we had, you know, the COVID recession, but that was only 2 months and things recovered pretty quickly.
Yeah.
So I think there is this misconception that it's easy. And the other one is that, you know, a lot of younger people I've seen are treating it like a casino.
Oh.
So, you know, the meme stocks, options trading, all of that. Again, I think it's amazing that there's all this information out there on the internet and social media, but there's also that flip side to it. And treating the market like a casino, I don't think is ever a good strategy. You know, that's, you know, Warren Buffett didn't make his billions off of meme stock trading, right?
Yeah.
So
No.
that is, I think, the biggest misconception. And at some point, we will go into a recession. I don't know if that's 6 months or 6 years, but working with a professional, you'll be able to weather those types of storms and take advantage of opportunities at the time too.
Yeah. There's opportunities when the market's going up, and there's opportunities when the market's going down. And like, to your point, you've heard all this, like you hear about people with the Bitcoin and the cryptocurrencies, which, you know, I've been invested in the market for years and years, and I would never dream of trying to go into one of those because I don't understand it well enough. Like I would never want to put my money in something that I just don't understand. Yet I've had people call me and tell me that, yeah, I bought, you know, 10 grand in Bitcoin and 20,000 in Bitcoin. And I said, do you really understand what you're doing here? Like how that's going to work? Yeah. And it's pretty interesting. I'm sure, I can only imagine you probably have people call and ask you about that.
We do get people calling and asking us about that. It's not something that we utilize in our portfolios. But, you know, I think one of the best rules of investing that you just mentioned is if you don't understand it, don't invest in it. That's something that my dad taught me, and I will stick to that one.
Yeah, no, I like that. That's something my dad taught me too. He also said, like, bulls and bears get rich, but pigs get slaughtered.
Yep.
So
that's a classic line.
Yeah. So never get greedy.
Yep.
Just take your profits, take your, you know, do your investing long-term,
Absolutely.
Long-term steady, ends up winning the day typically overall. But yeah, you know, to your point, there's so much out there on the internet and they make it seem like it's easy. It's like, no, there's a reason. There's a reason why you need professionals that can sit there and look at what's going on in the market every single day and just kind of know.
And I think it does also, you know, as you get older, typically your situation will become more complex. And so that's, you know, maybe, you know, as much as I say, ideally you hire someone at the get-go when you're young, but sometimes, you know, you don't have that capability. And so, you know, as your situation becomes more complex, that's really when you want to bring in, you know, the CPA, the estate planner, the financial advisor, the lender, everyone into that situation to help you through those times.
Yeah. Oh, for sure. And, you know, as we look towards like Gen Z that's coming up, it's been said that they're going to have a much harder time than our generation has had, like with saving, buying a house, saving for retirement. What would you say some of your tips would be for that generation? I mean, those are people in their 20s, I think, up to 27.
I know it's simplistic, but anything you can put away helps. Even a little bit, you know, $100, $200 into an investment account over time, that will grow and be very helpful when you're in your 60s and later on in life. One of my favorite tools, though, for younger individuals is Roth IRAs. I love Roths because, yes, you're not getting the tax benefit now, but typically when you're younger, you know, aren't in a higher tax bracket anyways. And once you get into a higher tax bracket, you're not going to be able to contribute regardless to a Roth IRA. Now, hopefully your company might have a Roth 401k option, but not all do. And so while you can to contribute to that Roth IRA, as long as you abide by, you know, the rules, then you're going to have that money grow for you tax-free. That is incredible.
Yeah.
and such an amazing opportunity to have that tax-free growth. Plus, you can utilize 10,000 of that to purchase your first new home. Now, that 10,000 probably doesn't go a long way in the Seattle region, but in other places that might be very helpful. So
yeah, I think a lot of people don't realize about the Roth IRA. Just to kind of clarify for our listeners, because a lot of people won't know. Can you kind of explain like what's the difference between like the Roth IRA and like a regular IRA, and then the Roth 401k option is a super interesting one. I know, and I would love to have you kind of talk about that.
Yeah. So a traditional IRA, you're going to put the money in and you're not going to pay the taxes now. It's tax deferred. So it's going to grow for you over your lifetime. And there are some exceptions, but in general, you're not supposed to take out the money till you're at least 59 and a half. And so when you take that money out and now you're in retirement, probably, that money is going to come to you as ordinary income. So just like a wage, just like your paycheck. And so you're going to pay the taxes then. And kind of the concept is, one, you're getting that tax deferred growth and you're saving for retirement. That's great. But also that typically in your high working years, you'll probably be in a higher tax bracket than you are in retirement.
Yeah.
And so the idea is that, again, you're going to be paying lower taxes on that in the future. That doesn't work for everyone's situation. That's just kind of a general thing. With the Roth, it's very similar, but you're putting the money in and you're paying the taxes up front, and then it's going to grow for you tax-free. And then again, if you apply by all the rules, the distributions are tax-free as well, which is incredible.
Fantastic.
Yeah. There are some other things there. Traditional IRAs are going to have what we call required minimum distributions associated with them. A Roth isn't. So there's a lot of benefits now in particular associated with that, and also in terms of inheritance and estate giving. So a Roth is just an incredible tool.
Yeah, and it's all based on what the income is now. So like a person starting out in their 20s that is under the income threshold, whatever, and does that change? That changes yearly?
It changes annually, and it also is based on how you're filing. Are you filing single, joint, head of household, all of those things? Yeah. So you want to double check those numbers to make sure that you qualify to contribute to a Roth.
I have to imagine, though, a person that pays their taxes in their 20s and is able to put that money in after tax and let it grow for 40 years. It's incredible.
It's incredible.
Like, it's an incredible. If that is one thing, if I could go back into my 20s and change, I would have. I mean, I don't think there was a Roth 401k option back then.
No, it's becoming a lot more popular now that companies are offering that. And, you can typically split your contributions too. You don't have to do all to a Roth 401k or all to the traditional 401k. You can split it. You can do different percentages. But it's really great that companies are now offering that as an option.
Well, and like you mentioned, so from the homeownership, for a home buying perspective, you can take, you said 10,000?
10,000, correct, yeah.
That's incredible. I bet you a lot of people do not realize that. You can take 10,000 out of your Roth IRA and have that go towards the down payment towards a home.
Your first home.
Your first home.
Yeah.
So you got to be a first-time home buyer, first home, and you get that money tax-free.
Tax-free, yep.
And penalty-free.
Penalty-free,
That's
exactly.
amazing.
Yep.
That's incredible because, a lot of times when people come and they're like, well, I don't have a down payment saved, and maybe they do have a Roth IRA and they don't realize that they're sitting on some potential down payment funds they didn't realize they have.
Yep.
That's a great one. So one of the big questions I always get, and I love to get your perspective on, is clients will say, what percentage of my income should I allocate towards a mortgage? Like, what makes the most sense? I always quote what our guidelines are, which is the guidelines will let you go up to typically 45 to 50% of what your gross monthly income is. Now, whether that makes sense for a client or not is another conversation. The guideline is there more or less because some people have more debt and some people have less debt. So the people that have less debt, it's saying you can use more of your income towards a house payment.
Okay.
People that have more debt, it says, okay, because you have this other debt, you could use less of your income towards a house payment. How do you, like, what kind of factors do you look at when you advise a client on what percentage of their income should go into a mortgage?
So there are some general rules of thumb. The number that we typically use is more around that 36%.
Okay.
So it's a little bit lower.
Yeah.
But we're also hoping that they're putting money away towards other things as well. And so it depends on the particular client situation and I think their trajectory, and we can model out income and cash flow projections for them, but it's sticking around that 36% is where we typically stay. But if we know that they're going to be making a lot more in the future, or they have a large inheritance coming, those things can help to tip the scales one way or the other.
Yeah, I could see that. Yeah, because all of those factors, those are all, and that's the thing is it's never a one size fits all. No. There's, there's always exceptions to rule because everybody's situation is just a little bit different.
Absolutely.
But,
yeah.
So, one of the questions, I'll have clients that come to me, they've been through a financial hardship. Maybe they have gone through a divorce. Or maybe they have had to declare bankruptcy. They've maybe lost everything, or maybe they've gone through a massive health issue. Okay. They're just kind of getting back on their feet. They are trying to make ends meet. They're trying to build their credit. They're trying to build their savings account up. What's some advice, or what are some steps you would say as a financial advisor or certified financial planner that you would tell them that are kind of key in kind of getting them on the right track to where they can start saving for long term and buy a home that they want to buy down the road?
So, I would want to look at that particular person's unique situation and look at their assets if they have any. Look at their liabilities. That's a big component. When a prospective client, or I'm meeting with a grandchild of a client, comes in the room, and one of the biggest red flags is credit card debt. That is, the top thing that I say, we've got to go after this. Or student loans that are a really high percentage. Often I'll see where they're saying, well, this is my smaller loan, so I'm going to pay this off first, even though that has a really low rate. And you have this other loan out there that has an 8%. So trying to get them on the right path to really reducing their debt that has those higher rates, that's the number one key thing that we'll focus on to start with. Yeah. And then after we get the debt taken care of, I think that's the biggest thing. Then going through and saying, okay, how much, let's look at your, expenses and go through these items and say, what can we get rid of? What's important to you? What do we need to maintain? And then what percentage can we start slowly putting away to, get on a better credit, to put some money away for savings? I mean, one of the best parts about owning a home that I think a lot of people don't talk about is that it's a forced savings plan.
Yes.
And that is imperative to be able to, people will really do almost anything to be able to pay their, monthly mortgage, right? That's the most important thing that they pay each month. And so that forced savings plan later in life to have this asset is so important, I think.
Yeah. Oh, absolutely. Well, first of all, it's the place where they live. It has a very emotional meaning to them. It's their safe place, but it's also, the statistics are undeniable that people who get themselves on the ladder of homeownership, like the sooner the better. Yeah. They are so far ahead. They get so much further ahead in life, just in savings and in lifestyle and being able to have a good retirement because they receive that appreciation through owning real estate. Yeah. And it is that forced savings account. And then heaven forbid, which a large percentage of people will get in this situation where they have a medical event happen, where they need that care, additional care. And a lot of times it seems that that's where it's that forced savings account that saves them because they can tap into that for those unexpected expenses that always come up.
Yeah, absolutely.
Yeah. One of the other questions I So with kids, when you're talking with people that have like children, young children, and they're like, well, hey, what would be the best avenue, or what are some of the best useful avenues of starting to save for them? Is it those college accounts, savings accounts? Is it, those, remember when I was a kid, it was the UNICEF, it was an UTMA account. I remember the UTMAs.
Yeah.
But I know now there's a lot more.
Yep.
And I remember when I got ready to go to college, my parents said, hey, this is what we save for you. This is what you can use to go to college. If there's parents out there that are thinking about, okay, how do I start? And what type of an account is really the most advantageous that I can start?
Yeah. So, college planning is a big part of what we do. There's two areas that have had a lot higher inflation: healthcare and college.
Yes.
So those we always take in a much higher inflation assumption when we're planning for that. And so I really like the 529. That's what I do for my two boys. And we just put away, a few $100 each month into a 529 account that's going to be growing for them. 529s are typically going to be similar to a target date retirement fund, meaning that they are going to, when the child is younger, they're going to be more stock oriented, a more of a growth portfolio. And then as they get closer to 18, the account is going to become more conservative, be more fixed income oriented, because that's when you're going to really be utilizing the money, right? Typically. But the 529s are great now because not only can you utilize them for college, you can also utilize them for private schools. You can use them. It doesn't have to be your traditional 4-year school. Let's say your child wants to go to culinary school. Great. You can use it for that. You can use it, to send them to a lot of international programs as well, too. So they're very flexible. You don't have to use it for just the tuition. You can use it for room and board, purchasing, books, all of that. So I think 529s are really a great way. We do get some clients concerned, well, I don't know if my child's going to go to college. That is, a question. You don't want to oversave, I think. And that's something that we work with clients on. But I think even if your child decides not to go to college, again, there's all these other avenues. You can also change the beneficiary of the 529. What I love is that the parent is the owner or the grandparent. It can be, anyone. It could be an uncle, whoever, but it's not the child. So they do not have control. Unlike certain other types of accounts, eventually the child will, become an adult in that particular state, and then they'll have access to those funds. You may not want a 21-year-old to have access to those funds.
Sure.
So I think 529s are just a really great tool. Again, everyone's situation is unique, but I really like 529 accounts.
As I understand it, the way those work is you're putting in, as a parent, you're putting in after-tax income. So it's similar to a Roth in that it's going to grow tax-free. And then as long as the child uses the funds for college-related, college-adjacent education or educational expenses, then it's tax-free when they take it out. Is that correct?
Yes. So as long as it's used for a qualified educational expense, and there's a whole list that you can go and look up what qualifies, what does not. But yes.
That's incredible.
That's incredible.
Yeah, very incredible. Yes. And even if they chose not to go to school, then what's the worst case? They just end up paying the taxes. Maybe they take the money out. They use it for a down payment on a house.
There is a penalty. There is a 10% penalty in taxes, but again, you run the numbers over time. I still think it's beneficial, but that is why we don't want to oversave for college, unless your child's going to Harvard, then maybe you oversave.
No, that makes
sense.
That
particular.
But it's interesting to hear, from the inflation standpoint, that those are the two highest that are hit the most. So healthcare and education seems to be the ones that are going up the highest. That's very interesting.
Yep, we model those out a lot higher than just your generic, living expenses during retirement. Absolutely. Yeah.
Okay. One of the things that I get is people will say, "Gosh, you know what? I'm pretty green on investing, but I want to get into the market. I know I need to be in the market because that's how I'll get ahead, but how do I trust the market?" They can look at these graphs and these charts and, they'll see a few weeks back where there was this big dip. And How are you able to kind of share with people that how do they trust a market? How do they, know when a good time is to jump, especially if they've got, they've just got a little bit of savings there and they just kind of want to invest a little bit. And over time, that's going to be more and more because we know over time it compounds, it builds, and they'll be able to invest more over time.
Again, everyone's situation is unique. But I do think it depends on what that money is meant for and what the goals of that money are. So ideally, when someone comes to me, I want to make sure that they have some liquidity. So I love to see anywhere from 3 to 6 months of their fixed and variable expenses in savings prior to them going into the market. That's kind of step one. I want to see that because yes, cash, although cash has a decent return right now, over time it hasn't had a great return, but it does provide liquidity. It's that rainy day fund. When you need it, you have access to it. So that's step one. And then after, once they have that, trusting, when it comes to the market and if you don't have a lot of experience, I would say diversification is key. Diversification is key. You don't need to pick that hot stock. You don't want to put all your money typically, especially when you're dealing with smaller size of money. You typically are going to want to buy something that is a basket of securities, not one individual stock. So that's, because then you're just placing the money into the market and you're going to let it do its thing over time, as opposed to having to pick the right individual stock. So
that's a great reminder. And I think a lot of people don't realize that when you're working with a professional like yourself, you have access to lots of different tools and lots of different investments. And just depending on their specific needs, goals, risk tolerance, you can help really create that plan that's going to help them be able to be in investments that are diversified to provide that. So that if one stock, if I'm hearing you correct, if one stock's down one day, another one's going to be up and it evens itself out over time. And that's a way to kind of trust that market.
To go into the market without having to pick that perfect stock.
What would you say, you over the years, what would you say that the specialties are in your practice?
Well, as I said, we really do focus on distribution planning, whether that be in retirement or with the estates. But one thing that I think would be, interested for your audience is lending. We will do what's called an SBL, or security based line of credit. And that doesn't always work. Again, it's very specific to the client situation, but it's a great alternative for people if they've already gone down the traditional route and perhaps they can't get a line of credit or mortgage through a bank. This is a way they can actually take their stocks, their investments, and take a loan against that. And it's what people really like about it is that it's fast. It's typically within a week or two. It's also no credit check. And you don't have to go through the bank. So it's being able to utilize these assets that you have. And we've seen that a lot, especially as people go into retirement and let's say they want to downsize. They want to, sell their large primary residence where their children grew up. And now they want to buy a condo. But they don't want to have to create a lot of taxes by selling all their investments. And so we can actually, take a loan against their taxable investment account and help them to create this bridge. And, there's lots of different options that people can go down, different routes, but this is just one of them. And I think it's been really nice to be able to help clients without having to create this huge tax event for them as well.
Yeah, this is a fantastic vehicle. I've had many clients, especially over the last few years, as mortgage rates have gone up so high. And because of that, equity line of credit have gone so high because on mortgages, for loans against a house, which is an equity line of credit, they're tied to the U.S. prime lending rate, which has been going up so much. So a lot of times people will tap into the equity they want to buy like another property. They want to leverage and they want to buy that next property. And that has really come in handy for many of my clients where they have a portfolio and they can set up, like it's almost like a line of credit against your portfolio, but you don't have to sell your investments. You can keep your money invested in your market and your investments. And like you said, you don't have to then pay the taxes on selling off those investments, but you can take that line of credit, which lets you use it for a down payment, or for the client that's downsizing, they can use that security line of credit for the down payment on that next property is like a bridge loan before they sell their next house. Or in this area, with the market still being so competitive and you need to close quick, and you can offer a cash. You can offer a cash option because you can just literally go pull from that line of credit, use it like cash, put it down onto the property purchase, and then when the departing resident's property sells, they can replenish and pay it back.
Yep. We've used that with clients in competitive bid situations, and they got the home.
Yes.
So I don't think a lot of people know that they can tap their investment accounts. Now, there's, of course, rules associated with that, and only certain types of accounts that you can actually do this against. Retirement accounts, you typically cannot take lines of credit against, but it's just a really great option I don't think a lot of people are aware of.
Is there a rule of thumb for like kind of is it 50% of the value of the account, or, a different percentage, or does that vary?
It does vary, and it varies based on the amount of assets that you have. So the more assets that you have, typically the more you can borrow.
Interesting. Yeah. Okay. Yeah. No, that's a great tool. I'm glad you brought that up because I've had many cases where, to your point, the clients will have just different sources, or maybe they're even in between jobs, and they need to tap into money, and they want to buy this particular property. And so that's one of the things that will come up is, hey, if you can borrow against your securities, that allows you to be able to finance it and the rates have been historically nice and low in comparison when I've run some of the comparisons to where like mortgage rates have been, or equity lines of credit have been. So it's a great tool. Yeah,
it's just a great option to, do the comparison, look at all your options out there and everywhere you can go from, and then,
Yeah. I notice you have a certified divorce financial analyst designation, which is very unique. I have not seen that very often. What is that? Can you tell me a little bit about that, and just kind of what additional services that allows you to provide to your clients?
Yeah, and unfortunately, we all know the statistics around divorce. It's something that a lot of us either are going to go through personally, or our friends and family members are going to go through. And so this is just an additional designation on top of the CFP that helps me work with clients that are going through the divorce process. Typically, I'm going to be working with their attorney, so with their family law attorney, to help them to go through this process. And so typically I'm helping the attorney a lot to provide them, looking at all of their assets, their liabilities, their income streams, their pensions, all these rental income, and trying to help them in terms of dividing those assets. One of the big things typically is with the primary home, right? So that's often when we bring in lenders into that situation, because often someone does want to stay in the home. Sometimes it really doesn't make financial sense. But again, your emotional, your heart, not everything has to make sense on paper. And so we'll work with lenders to help them to be able to see if that's an option for them to be able to stay in the primary residence. So that's something we do a lot during that process, is work with the lenders. But, not just in divorce, but in general, I think the statistic is 9 out of 10 women are going to be in charge of their financial household at one point in their life. And that is because women typically live longer than men. And so whether they're in charge from the beginning, or they go through a divorce or a death, they often are going to have to be in control of their household finances. So one of the best parts of my job is being able to work with women that are going through these changes. Again, whether it's a divorce or a big job change, whatever it might be, unfortunately a death has happened in their family, and help them to create this new plan for themselves, and so that they'll be in a good situation going forward.
Yeah. I think that people don't realize that it's so important that not only, if they are going through a divorce, not only is the attorney really important, but the financial planner's very important to have involved, because those investments all carry different tax consequences potentially. And also in figuring out what's the most advantageous way, dividing them up from that perspective, I would think provides a huge amount of, just a huge amount of value to both the client and the attorney.
Absolutely. And it's not, on paper you think, okay, we live in a community property state, so 50-50 perhaps down the middle. But like you said, different assets have different tax consequences. And so getting $100,000 from a Roth IRA versus a traditional IRA or a, investment account is very different. Yes. And so going over that with the client and, helping them to determine what is really a fair division of these assets is important.
Yes, for sure. Well, and a lot of times too, there is going to be like a refinance associated with that too. Like, especially if there is one of the owners is going to keep the house. If one of them is going to keep the house, but the equity position of another owner, they've got to pay the soon-to-be ex-spouse what their portion of the equity is. A lot of times what can be done with that can be handled through a cash-out refinance or a line of credit. And so that factors into the play as well. Or sometimes they'll want to keep the loan because the rates, if you have a rate prior to 2021, it's probably nice and low. And so maybe you don't want to touch that mortgage. You don't want to do a refinance on it. So you handle it with assets. You make the other person whole using some of the other investment assets as opposed to touching the property. Yeah,
and that's what we're going through a lot of right now. Unfortunately, when people are going through divorce right now, they don't want to go from a 2.75% mortgage to a 7% mortgage, because that obviously changes their ability to stay in that home.
Yes.
A lot.
It does. Yeah, it does. Or puts them in a completely different price point if they decide to move to a different property.
Absolutely.
Yes. Cool. Thank you so much, Laura. This has been great talking with you this afternoon. I feel like we've covered some great ground, and our listeners will learn some really, really valuable information that they did not already know. Thank you so much for listening today. And as always, please reach out with any questions. I've also tagged Laura as well, and feel free to reach out to her with financial questions. And as always, please like, share, and subscribe.